Tibrewal, Senior Fund Manager with Kotak Mutual Fund, joins us live with his quick take on where markets are headed. Pankaj, good morning. Is the worst behind us? Do you think markets are made a bottom? Do you think markets are only
Good morning,
getting
Pankaj. It's difficult to take a call on the index per se because macro worries are still there. However, some of the events which have happened in the last 10-15 days have soothed the market nerves. Clearly, you saw that equity markets are a function of volatility, and the events which are happening in the oil market, currency market, liquidity market, credit markets, and some of the events which in the last 10 days have come across. Oil has cooled down a bit. You have seen some stability in the rupee after moving from 63 to 74. You have seen liquidity coming back at neutral levels, which was in deficit in September, and some concerns on LNFS has been kind of taken over. So I think those things have kind of calmed the equity markets. In the near term, probably elections would be the next trigger where markets would be focusing on, and obviously markets would be taking cues from global parts. But Nikunj, one thing which is very interesting is that this time the underperformance of Nifty mid cap and small cap, which we have seen relative to Nifty, is the largest we have seen historically. Nifty calendar year to date is up and in positive, and if you look at the mid cap and the small cap, mid cap has corrected by almost 20%, and small cap index has corrected by more than 30%. So clearly from the top, you have seen that if you take the top 1,000 stocks in India in terms of market cap, there has been correction of more than 40% from the 52-week highs. That's the median correction. So I think opportunities have started to emerge from a bottom-up stock picking basis. We believe that we have seen this mood and these phases in the last 15-18 years as well. Is it darkest before dawn? We don't know. Can the night be a little longer? Can it get a little darker? Probably yes, but can you get the timing exactly right is something which we all need to ask ourselves.
Right. So Pankaj, where is it that you see opportunity now in the small caps, considering the correction has been hard there? The focal point of the fall of the market, I would say, was NBFCs. Would you say much of the concerns are in the price and behind us? And is that something that you're looking at actively? Not just NBFCs, but maybe financials at large, including banks, beaten down ones, or HFCs also for that matter?
We have been cautious on the NBFC space, especially the NBFCs which are more exposed to LAP, which is loan against property. Our cautiousness still remains. We believe that most of the NBFCs will have to recalibrate their business model in the light of new liability side issues. We believe that over the next 2-3 quarters, the commentary which is coming out, growth of NBFCs will clearly slow down. We see that as a great opportunity for private sector banks because we believe that the banks which have very high quality CASA and the liability profile and on the asset side you have lower competition coming across over the next few quarters. Many of the private sector banks are well placed. Some of the corporate banks where we have seen leadership change are also looking very interesting from a valuation perspective. On the small caps and mid caps, I think you have to go bottom up. You can't paint the entire universe with the same brush because the universe is quite large. Our interest lies in some of the specialty chemicals, some of the auto ancillary, some of the light engineering capital good names, some of the pharma names on a complete bottom-up basis. That's where we think opportunities are. We are more focused that over the next 2-3 years, which are the companies which can compound their profits by 25-30%, and hence our focus is to look more from a bottom-up stock picking ideas.
Okay, Pankaj, how are you looking at the earnings trajectory going forward from here? Do you think that what we saw in Q1 can be repeated in Q2, and more importantly in a rising rate scenario, that earning momentum can still continue?
So Street is baking in an earnings growth of 19-20% for fiscal year 2019. We believe that that's a slightly optimistic number. Internally, we are working somewhere around 13 to 14% earnings growth. And mind you, the headline earnings growth could be a bit misleading. Look at the first quarter FY19. Your headline earnings growth was around 10%. But if you remove the 4 stocks from Nifty 50, the headline earning growth moved to 27.5%. So you will have few bad boys which will drag the overall earnings growth on a headline basis for Nifty. But if you dip a little digger, the growth has been very, very strong. We believe that rising interest rates could hurt some balance sheet which are levered, maybe some infra companies which are more dependent on the debt side. But overall, over the last 3-4 years, we have seen deleveraging on the India Inc. balance sheet. So that bodes well in a rising interest rate scenario. It may not impact as much as we would like. What we are a little concerned about, that if NBFCs pull off and the growth rate slow down, PSU banks any which ways are not lending. 11 of the PSU banks are under PCA. You may have some credit availability issues going into the festive season. That may be not very good news for some of the SMEs. So we are keeping a close watch on how this space pans out.
So Pankaj, when markets currently, if one assumes that the worst of the macro scare is behind us, but how do you see the macro differentiation will start separating men from the boys within the small and the mid cap index? Because that entire rising tide phenomenon where you bought a stock on Friday and you sold it higher on Monday, and you bought the stock on Monday and sold it higher on Tuesday, that entire passing the parcel game is over. Where do you think outperformance and underperformance will lie in the mid and the small cap stocks?
A very, very good observation, Nikunj. I think over the next 12 to 18 months, clearly you would see differentiation between men versus boys in the entire mid and small cap space. The mad rally which we saw in 2017 calendar year, where everything worked and the market returns were directly inversely proportional to the size of the company. The smaller the company, the larger the returns last year, which is not going to repeat in our view. The companies which will show consistent earnings growth, which have a decent balance sheet to manage the macro volatility, will be the winners in our view going forward. It could emerge from auto anchors, it could emerge from specialty chemicals, it could emerge from cement, it could emerge from light engineering capital goods. So our focus is to identify those companies where the earnings compounding could be more on a consistent manner rather than more of a cyclical nature. So that's where I think the focus would be. I think we have to acknowledge the fact that there will be a reset in the valuations of mid cap and small caps. Most of the companies were trading at more than 20 PE till last calendar year end. This is not going to repeat going forward. I think there will be much more sanity, which companies will be rewarded and which companies we won't.
Okay. Pankaj, then give us your sense, because there are a fair number of headwinds on the macro front, on policy making, on politics in general. As a fund manager, what is your risk versus reward positioning right now?
So in the near term, obviously there's a merit to be a little cautious on the markets, because on the one hand you have the macros, which probably is keeping us on the watch. On the other hand, you have the state elections followed by the general elections, which market will be a little worried about. But we believe that if in this next 6 to 8 months, if you start deploying your capital in good quality compounders, I think over the next 2 years you will be rewarded. So we won't be as negative as we were or cautious as we were, say, 8 months back on the space, which is mid and small caps. Incrementally, we are started to find opportunities. The valuation may not be at the distressed level, but they have started to become attractive. In January 2018, the mid caps were trading at about 30% premium to their long-term average. The small caps were trading at about 25% premium to their last 10-year historical average. That has meaningfully corrected. Small caps are now almost 2% discount to their last 10-year averages, and mid caps are about 10 to 12% premium to their last 10-year averages. So I think we are started to see opportunities. Don't forget that now on a 3-year basis post the correction, the small cap index is just yielding you 5% annualized return versus Nifty return of 12.5%.
Right.
And small cap index is at the level where Nifty was below 9,000. So clearly there is some opportunity emerging, and we believe that investors who deploy the money in a staggered manner will be the winners for the next 2 to 3 years.
Well, that's prudent advice, and I hope all the investors watching this interview also follow that one. But Pankaj, great having you on the show.